7.1%. That's the punchy new annual interest rate one bank just rolled out for 12-month deposits, shaking up a financial landscape that's largely been stable. What's truly impactful here isn't just the number, but how this move signals a fundamental lesson in capital management. A lesson that even the so-called AI giants of the corporate world are now relearning, just like savvy entrepreneurs on the internet. For anyone holding significant cash, whether it's your side hustle profits or seed money for your next big venture, this isn't just news, it's a direct call to action. It's a reminder that overlooking basic, strategic cash positioning means leaving money on the table, a mistake no smart business owner can afford. This is happening right now, today, July 13th, 2026. Look, a survey of 34 banks today, July 13th, confirms most online deposit rates are holding steady. But Bac A Bank just broke ranks, boosting their 12-month rate to that 7.1% mark and nudging their 6-month and 9-month terms to 7.5%. This isn't just an isolated incident. It puts them squarely in an elite club of 7 banks now offering 7% or more for 12-month deposits. Think about it. While many assume all banks are the same, this crucial divergence means where you park your business's idle cash makes a tangible difference. For side hustlers building capital for a Shopify store or a new SaaS product, optimizing these returns isn't optional. It's foundational. ACB still leads the pack at 7.3% for 12 months, with Saigon Bank right behind at 7.2%. This isn't just about saving, it's about smart capital deployment. Let's get specific with the data. Bac A Bank didn't just tweak one number. They strategically bumped rates across several key durations. Their 6-month and 9-month terms jumped from 6.85% to 7.05%, a solid 0.2% increase. The 12-month rate, as mentioned, moved from 6.9% to 7.1%, and even their 18-month rate saw a climb from 6.75% to 6.95%. Contrast this with the state-owned giants like Agribank, BIDV, Vietcombank, and Vietinbank, who are holding firm at 6.8% for both 12 and 18-month terms. This isn't some minor fluctuation, it's a clear delta. For businesses using a float or building a war chest, even a 0.3% difference on 6 figures translates into serious passive income. The evidence is clear. Not all money is earning equally right now. Here's the often overlooked fact. In a market that looks stable, the real opportunity is in the details, in the micro shifts. While the big names in finance might seem monolithic, they're constantly optimizing every dollar, a fundamental strategic hedge that savvy side hustlers already practice. You, the entrepreneur, building your Amazon FBA empire or monetizing your YouTube channel, can apply the same principle. Don't let your hard-earned capital sit in a low-yield account. Your actionable step today: pull up your current bank's online deposit rates. If you're not seeing at least 7% for a 12-month term, it's time to explore options like Bac A Bank or ACB. Go earn that extra passive income. Hit that subscribe button for more actionable business insights. Savvy market analysts are already dissecting this singular rate hike. They aren't just looking at the 7.1% itself, but the underlying signal. Some financial strategists, like those at Bloomberg Intelligence, suggest it's a test balloon for broader shifts, hinting at liquidity adjustments within specific segments. Others dismiss it as an isolated move, a bank trying to attract short-term capital. For your money, it reveals how even a minor change can spark diverse interpretations, creating a knowledge gap. That gap is where informed side hustlers find their edge, knowing which expert to heed for capital allocation strategies. Recent data from the Federal Reserve's Survey of Consumer Finances shows that nearly 40% of Americans invest in the stock market, with the majority focusing on long-term growth rather than short-term gains. This localized rate adjustment might seem contained, but global capital movements are hypersensitive. International investors, especially those eyeing emerging markets, track these subtle shifts for broader market health. While not a direct global tremor, it's a data point in their risk assessment models. Think about how a slight interest rate bump in one region can influence where venture capital flows, or how it affects currency strength for importers and exporters. It's a reminder that even small domestic financial shifts contribute to the mosaic that international fund managers study for cross-border investment premiums. For instance, a 1% interest rate hike in the US can lead to a 5 to 7% decline in the Brazilian real, affecting imports of electronics and machinery for Brazilian companies. We've seen similar scenarios play out in financial history, where a single institution deviates from the norm. Cast your mind back to the late 90s .com era. Niche banks offered slightly higher savings rates to fund tech investments, appearing counter-cyclical. What happened? Those who saw it as an early indicator of shifting capital allocation found ways to leverage it, either by parking cash or identifying correlated sectors poised for growth. The lesson is clear. Individual rate movements, when viewed through the lens of past cycles, often foretell future trends for savvy capital deployment, even for micro-businesses. For instance, data from 1999 showed that a mere 3% increase in savings rates at a small bank in the Midwest led to a 12% growth in deposits within the first quarter. This rate hike clearly creates a divide. On one side, prudent savers holding substantial cash balances stand to benefit from the higher yield, essentially gaining passive income with minimal effort. Think early retirees or those with large emergency funds. The flip side, businesses reliant on borrowing for expansion could face slightly tighter lending conditions if this trend spreads, even if incrementally. The unexpected winners are financial consultants who identify these high-yield products for their clients, building a service around optimizing cash positions. Conversely, those with high variable rate debt could see increased servicing costs without a strategic countermove.